Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So while I seldom get this question, this is something that confuses a lot of business owners or they're not aware of. So I wanted to dedicate a quick episode to explaining the difference between an expense and an asset on your books and how you know what is what and how you know to book it properly. Now, you might be thinking, okay, Shan, my bookkeeper does all this stuff and they know what to do. Yes, but I'm going to tell you what is important so that you know what to tell them, so that they're the best informed and that you guys are on the same page with how to treat these things and the tax benefits and costs related to these things. So very simply, let's just look at expenses. Those are pretty obvious. Expenses are things that you typically consume. They're your typical operating expenses, the purchase of services for your business, for advertising, for accounting, for whatever it is. Maybe it's to buy materials. Maybe it's to buy ingredients, right? These are all expenses. So if I'm using an example of, say, a bakery, expenses would include like flour, sugar, milk, eggs, all the stuff, right? All the ingredients. And it could also include your rent. It could also include other things, right? So these are all expenses. Now, assets would be things you purchase that enable you to earn more revenue, right? So this is like tangible things. So in my case of a bakery, your assets might be, if you own the building, it might be the building. It might also be ovens or refrigerators or storage or freezers, whatever it is, right? So think about it like, is this going to benefit me over time? Do I need this in order to generate revenue? Is this part of my operations that helps me generate revenue? And it may seem like a funny question to ask because you're like, well, Shan, I invest in coaching, I invest in consulting, I invest in mentors, I invest in accountants, right? That all helps me generate revenue. Yeah, indirectly. But I look at I kind of think of it on the consumption. So you're consuming the services completely versus I bought an oven for my bakery. I'm going to use that thing. It's going to help me earn revenue over multiple years. And it's going to be in use in my business for multiple years. So if you think about it, I want to spread that expense over multiple years. If I bought a bunch of ovens when I opened my bakery, right? If I bought them, I have no idea how much these things cost, by the way. So if I bought a bunch of ovens for my bakery and I expensed all of that in the first year, oh my gosh, I would be incurring the expense of having to own and maintain these things, right? They would be continuing to help me generate revenue for multiple years going forward. But if I had called them all expenses in year one, then I'm not getting that offset. I'm not getting that offset to my profit. You want to be matching up in theory. When you're making money, you want to be matching that with the costs to make that money. So if an asset is bought and you're using it over, say, 5 years or 10 years to generate money for your business, then you want to allocate. You want to deduct that for those years, for 5, 10 years. So there's ways you can do this called depreciation. Now, depreciation is basically taking an asset and chipping away over time at the expense of the asset. So basically allowing you to deduct piece by piece the asset until it's gone through its useful life. I'm not going to go into the mechanics of depreciation beyond that or any type of bonus depreciation, Section 179 stuff, all that, separate episode. But ultimately, when you purchase an asset for your business, understand that it's treated differently. It shows up on the balance sheet, not the P&L. So if you buy a desk, you buy a computer, you buy a printer, and these items are over $2,500. This is key. If the items are over $2,500 and they can benefit your business for multiple years, they might be an asset on your books and you need to depreciate those. You wouldn't be able to deduct all of those in the same year you bought it unless there's some other type of tax law that enables you to do that. This $2,500, by the way, is called like a safe harbor threshold. So if you have, let's say you buy a MacBook or any type of computer, And let's say, I don't even know how much they cost because I'm a PC person. Most accountants are. But let's just say it's $2,000, right? Computer for $2,000. You can buy a computer for $2,000 and expense it. You can just call it an expense in the year that you bought it. You don't have to depreciate it. You don't have to call it an asset. I mean, you could if you really wanted to spread out that expense, but most people would say, let's just expense it. So you would just take that deduction. It would lower your profit. It would be a pure expense as though you paid for any other service or product, right? It would just go out the bank account and it would be called an expense on your books. Now, if you call it an asset, let's say it was $5,000 for one piece of equipment or machinery or whatever, right? $5,000. Okay, we're going to have to depreciate that over time and call that an asset. We would book the asset. We would not book an expense. The expense that we would book is depreciation at the end of the year to show how much it was used up by the formulas that we use for depreciation. So understand that there's a difference between assets and expenses when it comes to your business bookkeeping. And yes, your accountant, your bookkeeper, your tax pro will understand this and be able to manage it. But here's why it affects you and why you should care. Because this will tell you what the tax benefits are and how long you can use those tax benefits when you buy something. So you want to be strategic about buying assets. You want to be strategic about, hey, if I buy this thing and it's over $2,500, then I may have to deduct it over time. I won't get the full expense in year one, possibly. So you want to be strategizing with your tax professional to understand if you're going to invest in something, is this considered an asset? Should I be depreciating it? Will I get the full benefit in this year? Or what should I do, right? You don't want to be surprised at the end of the year that you didn't get the benefit that you thought you would because you thought you could expense the whole thing. It doesn't always work that way. And one more thing on assets versus expenses, right? So there are other things that are actually assets besides the tangible assets, which I would consider vehicles, equipment, machinery, computers, stuff like that. There's intangible assets. It's like, whoa, wait a minute. I can basically call air an asset, kind of. Intangible assets. Okay. That would be something like a website. Like you purchase a website or you purchase all the things to create a website. A website gives you value over time, right? A website is like investing in a digital storefront building. So technically, if you think about a website, that could be an asset because it will help you generate income over time, right? So in the spirit of that definition, a website can definitely be an asset and it would be considered an intangible asset, meaning you can't touch and feel it. And you can invest all of the website costs and depreciate them over time. You absolutely could do that. Now, another one is like franchise fees, right? So if you pay an upfront franchise fee to open up a franchise, say it's $10,000 or $20,000, you can then depreciate or what we call amortize. Amortize means depreciate for intangible. So we just like to throw extra terms around there for no reason. But so you depreciate tangible assets, you amortize intangible assets. So you're going to amortize that franchise fee over multiple years. And the whole point of this is to match up these deductions with how you're earning revenue, right? You don't earn all of your revenue for your franchise in year one when you paid for the franchise, right? So it wants to spread that out too. So understand the spirit of why we do it this way, the concept behind it, and why we will treat these things a little bit differently. So when you're purchasing things like a franchise, website, there's tons of other options for intangible assets too. But you want to be working with your tax professional to understand, hey, I'm investing more than $2,500 in this thing that I think is going to generate income over a long period of time. Talk to your tax pro. Make sure it's being booked properly and make sure that you understand the tax benefit you're going to get from that. There is no like, what's better, asset or expense? There is no what's better. There is just an awareness of how it works for both so that you understand what will be what on your books, what will be what on your taxes, and that you're setting the right expectation on what types of benefits you're going to get from these, how you're going to depreciate them, and so on. There are ways to be strategic about it, which is why I say work with your professional. But basically, that's what we're looking at, and that's what we care about. So if you did buy anything over $2,500 this year, you want to make sure you talk to your professionals to make sure it was booked right. All right. I know this was a little bit of a technical one, but I think this will help you understand that there are differences between these things and what to look out for when you're talking to your tax pro. If you're an entrepreneur who's just starting out, it can be overwhelming to think about all the responsibilities you have when it comes to financial management and taxes. Even if you've been binging this podcast, implementing all of it can be really stressful if you don't have a clear list of action steps and know exactly what you should be doing right now. Luckily, we organized all of this for you in the Business Financial Quick Starter. This is your one-stop shop for beginning steps of entrepreneurship so you can build your business confidently from day one. This is not me teaching accounting, no way. It's a specific set of essential action steps to save you a lot of time, money, and headaches as you embark on your own entrepreneurship journey. We cover everything from setting up your business bank account all the way through avoiding a surprise tax bill. Now, as a podcast listener, you get 10% off with code KEEPWHATYOUEARN, all one word. So dive in now and access your Business Financial Quick Starter. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.